Hi, today I'm going to talk about the Ulta Beauty stock, ticker ULTA, and whether it's a buy with the current price. So the Ulta Beauty is a retailer selling beauty products in the United States. They are all over the United States with about 1.3 thousand stores. They are selling private label products, their own collection and branded products, as well as the other exclusive products in their stores. So currently they are only available in the United States. However, the management thinks that it could be a global brand, so there is still plenty of opportunities to expand. So pretty simple business model. They have these retail locations where shoppers can buy all of these beauty products. Also, they are available in Target as well. Now, personally, I don't really know what makes these locations better than the competitors. However, the consumers have very clearly spoken with their wallets. If we look at the growth rate of their revenue in the past 15 years, it is basically a perfect growth curve, excluding this little lockdown period. And just recently, so the latest report is also a huge beat and also a huge increase in revenue despite the increasing rates, the inflation and all other factors which is bringing down the stock market lately. And no wonder their stock price is actually in the all-time high. Next up, let's look at the long-term fundamentals. So we already checked the revenue, but the same thing is going on for the net income. So again, almost a perfect growth curve, excluding this lockdown period. Same with the EPS and similar with the free cash flow. This is not as nice of a curve because, of course, the cash flow have to be reinvested by the company. Looking at the revenue growth rate, as you can see, it is peaking about 17% annually and maybe around 11% in the shorter term. Looking at every 7-year interval, we can see that around 15% growth per every 7 years. However, because they are also buying back shares very, very heavily, as you can see, they are buying back about 3.5% of their shares since 2017. Their EPS growth is even more impressive. So looking at the long-term EPS growth, it's about 25% annually in the past 10 years, and looking at every 7-year interval, we can again see that around 25% EPS growth annually. This heavy EPS growth rate, of course, could justify the fairly high PE ratio of 21. And indeed, looking at the trailing PEG ratio, the trailing PEG ratio is still below 1, so the trailing PEG is the PE divided by the trailing growth. Ulta Beauty's balance sheet is also very good, so Altman Z score of about 8. Of course, it went down a little bit thanks to the lockdown, but even at the very bottom it was 3.8, which is considered pretty good. They're easily able to afford to pay all their interest. Looking at their assets versus liabilities, we can see that they have more assets. However, I personally like a little bit better when the assets are growing faster than the liabilities. It seems like in this case they are growing roughly equally. But considering their earning, free cash flow and debt coverage, I don't think this is a big issue either. So one thing that is very, very impressive here is their return on invested capital. So they had a long history of very high return on invested capital. Even when they were under the COVID lockdown, they have about 22% return on invested capital, which by itself is very good. However, now that the lockdowns have ended, they have a 54% return on invested capital, which is again insanely high. I prefer companies which have above 30%, so it's definitely fitting that criteria. As we have discussed above, they do very heavy stock buyback. As you can see, their stock count went from 64.5 million to about 50.5 million. Stock-based compensation, as you can see, is also not too heavy, so they are compensating about 3.3% of their net income, 0.4% of their revenue, and 0.15% of their market cap, which is considered fairly low. I personally like stock-based compensation per market cap below 1%, which definitely is the case here. Now recently they are going in quite heavily into share buyback. As you can see, they are spending about 100% of their net income, and similarly about 100% of their free cash flow to buying back shares. Now this is on one hand good because the share count will decrease a lot. However, on the other hand, they have a very high return on invested capital, so I think they probably should invest into their business instead of just buying back shares. Also, their share price is not that low, so they have about 22 PE ratio. So again, a little bit questionable why they are spending so much money on share buyback instead of growing. Maybe they didn't find a good growing opportunity. Maybe this could be a good time for them to do that international expansion. So again, this is a little bit questionable for me, but not too big of a deal. So they have low debt, they have a lot of free cash flow coming in, so they can reinvest later on as well. And for us shareholders, it could be very good that the share count is seriously decreasing. Looking at the past growth rate, as you can see, it has been beating the S&P 500, even here from the lowest growth point, about 10.3%, it is still above the S&P 500 return. However, if you got in a little bit better time, then it has been above the 20% annualized return for you. And for those who got in at the best time here, about 37% annualized return. Looking at the checks here, as you can see, pretty good. The only warning here is regarding the current valuation. We will run the DCF calculation to try to find the fair value of this stock, and of course the growth has not really been stable because of that lockdown, but ignoring the lockdown, it has been a very, very stable and impressive growth. Next up, let's head over to the DCF calculator to try to find a fair value of this stock. As you can see, by default it says that it is undervalued. However, we have to fill out these forms to actually get a better valuation for this stock. So let's start with the net margin first. As you can see, the net margin have collapsed when there were the lockdown, and before that it was about 10%. Right now it's a little bit higher at about 12%. But some of these growth is fueled by all the stimulus money after the lockdown. So I would move this down to be similar to what it was in 2019. However, one thing to notice here is that there is a general uptrend as well. So I would like to keep that uptrend. So for the margin this year, I will go with 10%. And in the end margin, I will leave the 12% margin. So as you can see, it fills in this long-term growing trend without taking this temporary situation as a starting point. Next up, growth rate. We can look down in this graphicon. As you can see, right now it's around 15%. In the past it has been larger. However, it is pretty common for growth companies to start off very high growth and then gradually decrease. So I will go with the start growth. So this is the growth this year of 15%, and in 10 years time I will go with 8%. So we will going to fill in this decreasing trend over time. Next up, share buyback. So we have seen that the company is buying back shares very, very heavily. However, in the end period, I will actually decrease this a little bit to about 1.5%, simply because the shares will be more and more expensive and the growth rate will be lower and lower, so it will be more difficult to buy back this many shares. So we can check this share count chart, and as you can see, it continues the decreasing trend and levels off in the future. Next up, multiple. In this case, I will going to go with this 12 multiple, simply because the growth rate is about 8%, so a 12 multiple in this case makes sense. And using these values, we get a fair price of $740 for a 12% annualized return. Or looking at it another way, the current share price justifies roughly a 15% annual return over the next 10 years, if all of our assumptions hold correct. Of course, if there is a higher growth, we may have a higher return. So looking at the chart, maybe they will be able to keep up this 13% growth. And in that case, maybe they also have a higher multiple, let's say 15. And in that case, the expected return based on the current stock price may be as high as 19% annually. So overall, Ulta Beauty seems like a good value despite the high P ratio. However, as with every investment, you have to think about the risk. In this case, I think the main risk is that the Ulta Beauty is mostly just a retailer, and as a retailer, it has a lot of competition, as retailers generally have. And if consumer preferences change and they choose another competitor to buy their beauty products from, then of course the Ulta Beauty's margin and revenue could suffer, and that could mean that our projections are not correct and we will receive less returns than we are expecting. Okay, that was it for today. Thank you for watching and bye.